Hi, I'm Mark Mancini with VRB Outstanding. In this week's episode, we're going to talk about CPAs or accountants and what you need to know. So welcome back this week. I'm joined here this week with Ron Kelm. He's a CPA based out of Marietta, Georgia. And we have a bunch of questions and things to talk about, really. Just an open conversation. This is not tax or financial advice. This is simply a conversation between two people that share our stories. And I'm just going to let Ron introduce himself and his background with real estate investing and short-term rentals. Go ahead, Ron.
Thanks, Mark. I'm Ron Kelm. I'm a CPA. I've been a tax CPA for 35 years. I've worked for large firms. Originally grew up in Indiana, worked in Chicago and areas around there. Moved to Georgia in 2005. Worked for some medium-sized firms in the Atlanta market for quite a few years. And then in 2020, I went off on my own. I'm also a licensed real estate agent. That just happened a few months ago. I've always loved real estate, and I feel like the blend of being a tax CPA and a real estate agent is a great combination. It's allowed me to serve my clients even better because I'm really getting involved in the details of both short-term and long-term rentals. So that's my basic story.
So basically, when you talk to your clients and you can relate stories, I guess, about short-term and long-term rentals and share experience and advice, even going beyond just simple accounting. That's very interesting.
Yeah, very much so. I've really, I've always been interested in the short-term market, and I've really gotten a lot more interested in it lately. It's exciting. There's great investment opportunity. There's better cash flows. And I do some I've been doing some calculations for clients to help them decide whether a property is profitable.
That's great to hear. And I know the first question before we go into the short-term rental questions and conversation. One of the things I know people are going to ask right away, Ron, you're in Georgia. I'm in another state. They probably want to go to an accountant down the road from them, but I mean, is that really necessary?
It's not. I have tax software that allows me to prepare tax returns in any state. There are some states that are easier than others, but it's not an issue. And when you're talking about short-term rentals, you're often talking about resort areas, and that's, south part of the country, the mountains in Georgia, North Carolina, Tennessee. I'm familiar with all those states, so it's not an issue. And in fact, I just picked up a client in Ohio who has a number of non-real estate investments and files multi-state tax returns. And their CPA in Ohio didn't feel comfortable doing short-term rentals. And I was referred to them, and they have a short-term rental in Ohio, and they're building a property outside of Asheville, North Carolina. So I'm now their new CPA because their existing CPA just wasn't comfortable dealing with short-term rentals, but he was comfortable dealing with multi-state returns. So I find that interesting, but it does kind of lend itself to the fact that there are some nuances in short-term rentals. And oftentimes CPAs just say, I can do it all, and this was a person who apparently just didn't want to do it all and decided to defer the client.
That's interesting. In fact, and for full disclosure here, actually, Ron is not my personal CPA, but Ron is actually a friend of ours. I get my accounting done out of state as well. The accounting firm I use is based out of Atlanta. They're not taking any more new clients, so that firm didn't want to be part of the video. But Allison introduced me to Ron, and Ron and I had several conversations. In fact, Ron's a student of our VRB Outstanding course. And it's interesting because we have short-term rentals in Florida. We live in South Carolina. Our CPAs in Atlanta. My wife has properties she owns not only in South Carolina but in Indiana as well. And there's not that barrier anymore, especially with COVID. You mentioned that there's that barrier where you don't have to go down the road to an accountant, especially if an accountant near you isn't well versed with real estate investing. And I know, Ron, I want you to share a couple things about the importance of knowing a CPA, knowing the difference, like for instance, with active versus passive investors, and what opportunities there may or may not be there from, especially if someone's a new short-term rental owner. They may be classified as a passive real estate investor, but there may be opportunities that they want to take that further, just like you did with being a real estate agent. So is there anything you kind of touch on without giving any tax advice or guidance there that may be an opportunity for them?
Yeah, well, active and passive and non-passive, passive and non-passive income can be a mess. The rules are extensive, and but I'll talk about it a little bit in general. With respect to real estate, by definition, real estate is passive. And what passive means is that you can only take deductions to the extent of bringing your net profit down to zero, or you can, if you do have losses, you can offset them against other passive income. So you might have passive income from other real estate properties that you own. You might have passive income from a normal trader business where you're a minority owner and do not participate in management. Then, so if you have, say it's a family business and you own 10% of it, but your brother runs it, he's the one that's active in it. Well, for you, that's passive income. So if you have a situation like that, passive losses aren't going to be a problem for you because you have passive income to net them against. So then the code gets a little bit more extensive, where with material participation or active participation, which are two different sets of rules, you can take your real estate losses in a current year.
Interesting. So basically, for people who do outsource their property management to companies, that kind of takes some possibilities for deductions off the table, I guess.
Yes, because when you're using a property manager, there's no way that you're going to meet the material participation rules. And so as a result of that, you'll be limited to net zero. Now, that doesn't mean that you're not going to ever be able to take those losses. If you consistently have losses of 10 or 15 or $20,000 a year because of depreciation, you may cash flow positive, but for tax purposes, you may be generating a loss. And if you are in the passive category, you won't be able to take those losses in the current year, but they accumulate as passive loss carryovers. And they continue to accumulate until you either have other passive income that you can net some of those losses against, or you sell the property. And then when you sell the property, any past suspended loss carryovers are able to be used and offset your profit.
So it's interesting. So it just came to me, and it just wasn't really planned. So I guess investing in VRB outstanding and managing the property yourself, aside from being a tax deduction, would help possibly get you to take advantage of some more tax benefits by switching out of the passive role, then possibly.
Yes, it will. Yeah, if you're in an active role, then you can take those losses right away. And there's hours requirements. There are regulations that state how many hours, and there's 7 different tests that you just need to meet one of them in order to qualify as active, as material participation.
And so it sounds like to me, you should probably meet with your clients a couple times a year, maybe.
Yes, I mean, I like to meet with my clients quarterly, just to review what's going on. And if it's a new property, you want to start talking to a CPA before you even purchase it. And particularly from my end, I'll help you do those cash flow analysis, see what your rate of return is. But there are strategies that can be employed based upon other other tax events that you've incurred in the year. Maybe you've sold some stock, you have a gain, so now you need to time the purchase of the property accordingly. And the later in the year, it's a little harder to meet the material participation rules, but there's 7 different tests. There's one that can be pulled out for somebody who just bought an STR on December 1st. They only have a month. There is a way to qualify for material participation, even owning it shorter. But the longer that you own it during the year, the easier it is to meet the requirements.
And that's actually an interesting topic, but I'm going to save that for part 2 with talking with your getting a CPA and having that dialogue on a regular basis, because just like you recommend, I meet with my CPA quarterly. I recommend in our course that we do that as well. And especially I want to mention that during these tough times of getting bookings with the recession that we're in, with inflation, we have a special going on right now for only one person. The very first person to use this code below gets the course. Instead of $795, they get it for $199, but it's only one person, one code, one time. So go ahead and put this code in when you check out at VRB Outstanding. What I want you to do is subscribe to our channel, because next week we're going to have part 2 with Ron. We're going to go into even more details of depreciation and saving money in taxes. Remember, hit like and subscribe below. Throw your questions in or reach out to me with questions, and we'll answer those as well. We'll see you next week.